The meeting will be called to order, and this is the Monday, December 16th meeting. And the first order of business is the approval of the minutes from our previous meeting, which was November 25th, I believe. Is there a motion?
Move to approve the minutes.
Is there a second?
Second.
It's been moved and seconded. All in favor? Aye.
Aye.
The minutes have passed, and we will turn it over to you to take us through the agenda. Thank you.
So the next item on the agenda is the security transaction report. And this is from November 18th through December the 6th. During that time, we purchased $215 million in securities and redemptions. We had $105 million, and we had one call, and that rate on that security was 5.112%. So you can see why it's being called, because
Right.
all those 5%ers are being called away because of the lower interest rate.
Correct. Is there a motion for the approval of the security transactions?
So moved.
Second.
It's been moved and seconded that the security transactions as of December 16th be approved. All in favor? Aye.
Aye.
That
motion is also passed.
The next item is the swap portfolio report as of November 30th, 2024. And as of the date, it was $8,520,445 compared to the month before, which is $7,981,185. And respectfully, the portfolio increased because of the decrease in the 10-year Treasury. So it's an inverse relationship. So as the rate decreases, the amount of the portfolio will increase. And this represents the amount that if we had to unwind or wanted to get out of the swap portfolio, the amount the city will have to come up with
Correct.
to unwind it.
Are there any questions? Hearing none, that report is accepted. The next order of business.
Okay, so we're coming back to the board again. Last year, we had the debt study done by the Public Resources Advisory Group, and we're coming back because when we had the discussion last time, we were talking about when we reviewed the ratios, that we will come back to the board and give our recommendations of what the amount of our borrowing would be. So we're coming today asking the board to approve increasing the general obligation bond borrowing to $125 million for fiscal year 26 and 27. And just as a review, when we brought Prague on, they were commissioned to give us recommendations on changes or amendments to our existing debt policy, to look at our annual borrowing limit as well as our key debt management ratios. And they developed a financial model to help establish the policy guidelines as they took on, as we provided them with the financial positions the city was in at the time in 2023. And out of that study, they gave us 4 recommendations. One was to adjust the city's debt management ratio to reflect more conservative target range. Number 2, to begin tracking the city comprehensive liability profile, which will include self-supporting debt, pensions, and OPEB. 3, to increase the city's annual debt issuance gradually over time to address the city's aging infrastructure as well as any deferred projects we have. 4, to maintain historical practice of the planned pay-and-go spending and also to continue our strong budgetary reserves. And finally, to establish a policy to test debt management ratios at least annually due to the increase of our borrowing assumptions. Also, when they did the study, we had them go through multiple scenarios, and in that they confirmed that the city could actually gradually increase our borrowing limits up to $200 million annually by 2032. But they also cautioned us that we should continue to monitor our performance, and if they're not consistent with the assumptions, to make the appropriate corrections. So based on that process, the city has, or Treasury Management has incorporated a formal debt management process to annually review the financial indicators to assess our affordability level and to assist the Department of Planning in the capital budget. So in the plan, the study, they had, Prague gave us a recommended matrix that we should follow. One was the 10-year GO bond payout ratio should be above, industry standards is that it's above 60%. The general fund balance and the general fund revenue should be above 8%. The debt outstanding as a percentage of full value, that's property value, should be either targeted at 3%, the ceiling as 4%. Debt outstanding as a percentage of personal income, the target is 4%, the ceiling is 5%. The debt service to the general fund revenue, target 7%, ceiling 8%. And then the last four, we would monitor the fixed cost to the general fund revenue, the long-term liability to the general fund revenue, and then the fixed cost and the long-term liability as compared to all the revenue that the city received. So in the report, I also provided you with the current outstanding debt for fiscal years 22 through 24. These are 22 and 23 are the audited numbers, 24 are under audit, and 25 is the projection. So for 22 and 23, we have about $4.5 billion outstanding. In 24, we have $4.3 billion outstanding, and projection for 25 is $4.1 billion outstanding. This does not include any new issuance. So going through all of that, we did run the scenario again. We had some updated numbers to run our numbers for this fiscal year. And scenario one, it was to maintain the same level that was in the debt study, where we had $80 million for 2025, $125 million for 26 and 27, $140 million for 28 and 29, $170 for fiscal years 30 through 34, and then thereafter we would issue $200 million. So after we compared the study from 23, and we also had a refresh of those numbers when we were considering the citywide affordable TIFs. So we refreshed those numbers. So looking at those numbers, there was no significant difference in the scenarios that were presented to us for that. In FY28 through FY28 through FY30, we fell slightly below the 60% floor. But however, we feel that this is manageable because we'll consider how much debt that we will issue during that time. And if we have to bring it down, we will not issue as much as the projected level is. So the 125 is actually the amount that the city will include in the budget, but it doesn't mean that's the amount that we will issue during the year. We normally issue in a reimbursement basis, so we have control over what the debt level will be. Okay. And then for the second scenario, because a couple of outer years we fell below the payout ratio, I just ran some numbers at a lower rate. So in FY26, I lowered it to, instead of 125 million, we did 100 million. And in FY30, instead of doing 170, I did 140. Once again, the payout ratio in 1 year, we actually hit the 60%. The other ones were slightly below, it's still like 59, 58%. So the percentage amount of not making the, the target, it wasn't very large. So saying all of that, our review concludes that the city should maintain its annual budget GO borrowing at $125 million for fiscal year 25 and 26. And the city will continue to monitor the numbers and evaluate the future debt issuance to protect its rating and ensure compliance with the benchmark debt ratios. So,
Are there any questions? Yes, sir.
Good afternoon.
good afternoon.
I apologize if I asked this last year and I didn't remember.
Okay.
But back in the background, I noticed that it says that the 2023 debt study includes recommendations to adjust the city's debt management ratios to reflect more conservative target ranges. And yet, we end up suggesting that we increase our GO bond borrowing by 2.5 times. And I'm calling attention to this not because I'm unhappy with raising our target. I'm just curious about why why this is described as to reflect more conservative target ranges when we are, I would characterize it as more reasonable ranges given our resources. But where did this wording come from?
Conservative?
Yeah.
I have a guess, but Janelle, if you want to.
You could go ahead.
So there's kind of two things happening here. There's the debt policy that the city takes on, which, among other things, sets these ranges that we're telling ourselves we have to live within. And then there's the actual debt that we take on. The debt that we take on does keep us, by and large, within these ranges, with just one that we have to keep an eye on. But it's the ranges themselves that the new debt policy kind of sets, where we commit to staying in these envelopes that are inherently more conservative than what we used to do in the past.
Okay, so we did have target ranges in the past that were less conservative, even if the way we ended up interpreting/exploiting them was to borrow less money.
That's at least my understanding. Janelle, is that your understanding as well?
Can you say that again?
I'm not sure, but I'll try. That would imply that we used to have more liberal target ranges that, despite having more liberal targets, we chose not to take advantage of the full range and actually pursued a more conservative borrowing strategy despite a wider range of options.
That's correct, because
Okay.
there's some years that even though we had a target amount of 80 million, we didn't issue 80.
Okay.
We may issue below that. So
Okay, now that's thinking it. Okay, got it, thank you.
And I'll just make one quick comment on some of these targets, just in case the public is listening. A number of these targets, these more conservative targets that we are now setting by policy, these different scenarios are well within the safe range, particularly some really important ones like the general fund balance and general fund, the sort of the ratio, the general fund balance to fund revenues, the piggy bank of how much we have in the worst case scenario. All of those are in an extremely safe range. The only variable that comes into play at all is the payout ratio, which is really kind of a measure of how young your debt is. And almost by definition, if you go from a place where you're not issuing much to where you're issuing more, your debt's going to get younger for a period of time. Some of these tables, if they were pulled out 15 years or 20 years, you see that ratio getting back up over 60%. You sort of just almost have to swallow the new issuance in order to get to this level. The level itself, these ratios to me shows is very sustainable, considering that both sort of as a percentage of full value, percentage of personal income, percentage of general fund revenue, we are kind of very well deeply within safe ranges.
Yes, sir.
Along those lines, Yeah, at some point, and this doesn't have to be the point because it's ridiculously cold in here, but at some point, I am a little curious about the general fund balance to general fund revenues ratio that is so far above the target number that I'm just curious what the rationale for that target number was. But it does, that one doesn't have to be now.
I can speak to it very broadly from just my experience in other jurisdictions. This is a number that's a national industry practice, and quite frankly, we just do much, much better than it.
Okay.
We have maintained very healthy
So
rating
it's-
baselines.
Its significance is that it just shows how much better we are than the best practice. Okay.
When
I
that
think
particular
it
level.
also helps with the bond rating.
Oh, sure.
So that it begins to show that the city is stronger financially.
And then the other question, the question I really was more interested in was there are these three metrics: the debt outstanding as a percentage of full value, as percentage of personal income, which, by the way, is always a fun one to use with a city, like to think of our personal income as a city rather than as a human, and then debt service to general fund revenue. In all of those cases, not only are we well below the ceiling, we are below the target. And I was just curious if this chart played out to fiscal 32, which is, I think, where we're expected to max out at the 200 million point. Do they hit targets at that point? So that target is oriented so that when we hit our proposed max ceiling, then we're on target, and we just have to make sure that the ratio stays below the ceiling.
Janelle, do you mind if I answer?
Okay.
Because the answer from a kind of policy and decision point is yes, that is exactly how it was designed, with one big caveat, which is that Prague gets a little nervous when you go out 10, 15 years with all the unknowns, which is why they prefer sort of this date range. With that being said, we are thinking from a decision perspective about the 10 years. And yes, the idea of going up to 200 is built around the idea of going to these targets and having a healthy debt amount and a healthy capital plan for the size of our city.
Well, I don't need to see 15 years, but if for next year's, if we could just add one more column next year, adding one more column should get us to 32. And I just like to see what the chart looks like as we ramp up to the max point. It should. I hear what you're saying, though.
I'll make a
So I'm
note
reassured.
there, which is that 32 will just be the first year that we hit that highest level. Debt does accumulate over time.
Yeah.
So
Yeah.
it might in fact be 33, 34, 35, where it sort of levels off at that target range. But yeah, absolutely.
And the first year actually is only going to include interest. It wouldn't even include principal, so
Sure.
we have to go out
That's
another
fair.
year to
Okay.
add in the principal as well.
Well, I guess I'll just have to keep coming back and keep watching these year after year.
Yes.
Okay. All right.
I think that was a very smart statement. And that's a target as well. I would just take a minute to commend you, Ms. Rogers, for the information that you provided. You made a tough subject seem simple, and it was not only your write-up, it was also some of the charts and schedule. And Mr. Comptroller, I would also say that the meeting when the Prague report was done, your input and basically indicating some of the information you would like to see helped shape this report, but you can see how simple it has become to interpret. The information is complicated, but the interpretation is very good, and just want to commend you.
Thank you. And I just want to say that also the city was able to inherit a financial model to model out this as well. So that's, one of the good things that we got out of getting the debt study done by Prague as well. So not only did we revise and strengthen our policy, but we also got something tangible
Sure.
to walk away with, too.
Thank you. Are there any other matters to be brought before us today?
None at this time.
Well, we have to approve this, right?
Okay.
Yes, I'm sorry. You
I
did.
apologize.
No
I would ask for a motion to approve the general obligation borrowing level for years 26 and 27 at the 125 million level.
So moved.
Second.
It's been moved and seconded. All in favor? Aye. And with no other matters needing to be brought before us today, I would just ask for this meeting to be adjourned.
Thank you.
Thank you.
Thank you.